All right. Hello, everybody. Thank you. If you're watching on YouTube, let me know you can hear me. Thank you, Alex. Thank you, Mike, for saying hello, for coming on in. It's good to see you. My name is Jeff Gibby. Today, I'm going to do the introductions, say hello to everybody, help with any questions that come up, all that kind of good stuff. So it's good to see you. Thanks for coming today. So let's go ahead and start with the legal disclaimer. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor is it paid for the promotion of any security. No information contained in this presentation should be construed as investment advice or the solicitation to buy a security. So I want to say thank you for coming. If you're watching us on YouTube, hit like, subscribe. Those things help. If you have any questions, regardless of where you're joining us, ask. I'm going to keep an eye on any questions. I'm going to pass them on, and we'll do our best to kind of answer them and make sure everything's coming through. So I do want to say a couple things as we get started. I know this is a targeted thing to our audience, or to our Australian audience, which I love doing. But I wanted to let you know that we've had a long-running partner in Australia that does a really, really good job. They provide local support. They can help you with data. They can help you answer questions. They can help you during your hours. And they do a really, really good job. So if you're interested in kind of a local provider for Metastock, you can go to metastockaustralia.com.au. You can give them a call at 03-9459-2317. And if you've never tried Metastock before, you can do like what we call an extended trial, where you buy a month, get the second and third month for free. And you can do that right here, metastock.com/Traders Oracle 3-for-1. So our big appreciation to Traders Oracle. Craig has done such a great job being a partner of Metastock down there, and we really, really, really appreciate it. I just noticed that this kind of is weird. That doesn't really say anything. Anyway, let's go ahead and kind of go to the next page. I do also want to say thank you to our friends at the Australian Technical Analysis Association. The Australian Technical Analysis Association. They've been friends of Metastock for a number of years now. We do a lot of work with the ATAA, and if you are interested in kind of getting involved with them, I'd recommend it. You can actually come in, test drive what the ATAA can do for you, and you can do a free, no obligation trial, free 1 month. And here's how you do that. Actually, I'm going to probably type this out just because it's a little bit of a long address, and I want you to be able to get there. So it's ataa.asn.au/metastock-2024. Go ahead and send that over there, and I will also put that in the YouTube comments in just a second. So hold on, if you're in YouTube, I will put that link in there for you. I do want to kind of get everything moving. So great audience today. Again, if you have any questions during the event, probably what will happen is I will, towards the end of the event, I'll ask Gary any questions that you have. So make sure to pass them along. I've got the chat right here. I've got the chat on YouTube. I can see them. I'm here to help. So without further ado, I want to actually kind of, I really have a story about Gary. I remember, like, this was a while ago, but I remember being on, I think it was down in, I think we might have been in Sydney or we were in Melbourne. I don't know. It was after this like 72-hour flight. And it wasn't really quite that long, but it was pretty close with the layover that we had in Japan. But I met Gary, and he was doing some work at the time with the ATAA, and we had kind of talked a little bit about what he was doing, and he kind of introduced me to the Haguro method, and it's a method that I very, very much liked. And so I got home, I emailed Gary, he sent me some of the rules, and it's something that we've actually coded for Metastock with explorations and things that you can run in the software. And it's a product that I've been really, really proud of. And I really like kind of the methodology, what's involved in it. I do a webinar of my own that I call the Hidden Gems of Metastock, because I think it's one of those really cool things in Metastock that not a lot of people look at. So I was really happy to bring Gary in to kind of have him talk about the Haguro method and kind of his take on trading. And it's something that I'm actually really, really curious to see personally. So without further ado, let's go ahead and get you in here, Gary. Gary, how are you doing? You can go ahead and I do remember that.
Jeffrey, yeah, thank you. Very good.
Good.
Very good. Hello, everyone. Welcome.
Were we in? We were in Sydney, right? Or
yes, we're in Sydney at the Traders Expo.
Yeah, okay. I just made the presentation for you.
Yeah,
I do remember Austin to Melbourne in that trip, but I remembered I was really jet lagged. So, but it was great. It's been a lot of fun to work with the Haguro method.
Yeah, let me get. Oh, there we go.
All right.
All right. You should have my full screen now.
I can see. I can see Metastock 18. Yes.
Yep.
Okay. Cool. In that case, I'm going to turn off my camera, and I am going to get out of the way. It's your turn.
All right. Thanks, Jeffrey. Welcome, everyone. Welcome to this presentation. I met Jeffrey at the Traders Expo in Sydney, and he took a lot of interest in what I'd spent a number of years looking at and had developed up. It's not my work. It's out of a book called The Japanese Chart of Charts. I'll go through in a moment. But Jeffrey liked it so much that we spent, I think, well over 3 months corresponding backwards and forwards. And Jeffrey did an awesome job in programming it into Metastock with some very, very useful tools. So we'll get ourselves underway. So our presentation is around the Haguro method. As always, this presentation is not to be implied as financial advice in any form whatsoever. So today, as always, I would like to first of all talk about trend and price structure and some swing point observations, and then we'll get to the Haguro method because your technical analysis is encompassing a lot of observations about the market. That's what it's about. So we'll go through some basic observations first about price structure. The book that I referenced a moment ago was the Japanese Chart of Charts, and I picked this up out of a company's library at the time, back in nearly 2002, and got reading through it. Very difficult read because it's badly translated into English. It was translated at the late 60s, around 1970 sometime. And there's some very difficult in some of the phrasing that how they've translated. But anyway, we worked through it and came up with the Haguro method as it's described in the book. It's a very old-fashioned book, so there's some statements that were made in there that I think are worth repeating about our approach to the market. And it talks about Honma, who was a trader in Japan. The port city of SAKATA was a marketplace and distribution point for Shono rice, and Honma became a trader of the cash rice market within the city. And so the song of the day, which they would make songs about, when it shines in SAKATA, it's cloudy in Dojima, which means that if there's a good rice crop in SAKATA, the prices fall on the Dojima exchange. And it's exactly the same today. Any lithium player would understand that when there's an oversupply or a continual supply coming onto the market, prices at the exchange tend to fall, and that's our job, is to recognise these ebbs and flows in the market. So Honma's 6 methods around that were, and some of them fairly obvious. Without being greedy, think of time and price by looking at the past price movements. Aim at selling at the ceiling and buying the bottom. Of course, that's our job. And one should increase one's position 3 times after a rise and liquidate after a fall. And if a forecast is incorrect, one should pick up the error as soon as possible, then we rest. And that's really referring to this revenge trading thing, trying to get something back when you're not in the right frame of mind. And one should liquidate at least 80% of their profitable position before the market has reached a ceiling or a bottom, and fully liquidate and reverse the position when the market shows a top or bottom. So it's essentially trading strategies that are still used, as everyone knows today. So the context of the Haguro method was that we must, as technical traders, we must consult the market about the market, which means we ask the market to tell us what's occurring. And the market is very repetitive in some of its instructions to us, and we should look at the market movement itself rather than look at economic policies. And because the market, anyone that studied Dow theory would understand, markets are very forward-looking. Don't always get it right, but they're very forward-looking 3 to 6 months out, and about how economies are actually going, and it's getting priced into markets in today's pricing. The trader should look at the market movements as the ebb and flow of the river of the greater market emotions. And as far as wanting to try to predict future movements of the market, the chart comes closest to achieving this desired outcome. It is impossible to predict future movements of the market. It is not impossible to create a system around what would be the most likely outcome of future movements in the market, and even those can be wrong, as we know. Nothing adds more to the severe reality of trading than the realities of day-to-day price movements, and no two patterns are exactly the same. The real application of the chart is to speedily identify tops and bottoms when they have been set, not to predict tops and bottoms. Interesting statement in there. Because so much in social media, there's so much prediction going on without any evidence of something to show. First of all, I want to talk about this thing called fluid movement. Fluid movement of price. So fluid movement is essentially what I refer to as the primary, what we call the primary move of prices. When prices are going singularly in one direction at a time, it becomes the primary move. And so on the left here, I have a daily chart. This is Australian stock CBA bank, and on the right-hand side is the weekly chart of the same price structure. And we can see in the weekly chart, which is really where primary moves are observed, is the bars are essentially standing on top of each other. So there's straight away observed as there's a primary move underway. We saw that in silver and gold. The last few days, particularly last week, we saw what's called a primary move in there. And the issue is that primary moves lend themselves to then create secondary consolidations within the market. And the secondary consolidation is simply observed when price bars overlap each other, when trading occurs in an up and down fashion around a price or around a support resistance level, but we get these periods of consolidation. The periods of consolidation are where we start to look for entries or exits out of a position by applying some analysis to them and make a decision around that. So in our daily chart on the left, secondary consolidations. In our weekly chart, it's starting at the top here, starting to really build into a weekly consolidation or secondary market up there. Just another example of this. This is Tesla, secondary consolidation, then a primary move out of there, secondary consolidation here on the daily, one move out, and then a secondary consolidation, and then the reversal. And the same we can see in the weekly chart, the secondary consolidation here on the right-hand side in the weekly chart, and then ultimately leading into reversal. One of the key aspects of trend analysis, and it's there's always been a lot of discussion about what constitutes a trend, and the media picked up, well, it's a 20% advance in prices or a 20% fall in prices and things are in a downtrend, or a 20% advance, things are an uptrend. And there's clearly not in any textbook that I've ever studied in my life, that's not described that way. A trend is essentially when a stock is making a series of higher highs and higher lows, or lower highs and lower lows. Inside Metastock is a little zigzag tool, which when applied over your price action, and we use 10% as a filter, then it starts to define our internal trend of a stock along the way. And what we're observing essentially is these higher highs and higher lows, and higher highs and higher lows, and then it moves into a lower high and a lower low, and lower highs and lower lows, then a higher low, and then a higher high. So the purpose of that is the purpose of that is this observation here, that when market makes a trough, market makes a high, market makes a higher low, and then crosses the previous high, then at that exact point, we declare a trend. So it must cross the previous high, which means the buyers are willing to pay a higher price than they were at some period in the background when they were willing to sell it down into a lower price. So a rising trend must be identified by way of higher highs and higher lows. In there, anybody that's in Australia that's ever been to any one of my talks over the last 20 years, this is what I talk about, is this structure of price. And then when we apply that observation to a chart, we can see the higher high, the higher low, and we break into a new high over here on the left, and that line there is our trend point, and hopefully trends will continue. And then as we make a low, then a lower high, and we break that previous low, then a downtrend is declared, and that follows through until we get a change in price structure with a higher low. We break through the high and we move into a higher high at some point. Hopefully that trend will continue. This is Microsoft, by the way, nice example of identifying a trend. And so along the way, we get these primary moves and secondary moves again. So in this weekly chart, we can see our secondary moves develop over a number of weeks and a number of months in there. So the basic concept around that is that secondary moves can last from 3 weeks to many months. And if you go through your charts very carefully, you'll find that these secondary moves really at a minimum sometimes last from 3 weeks. There's one in there for 2 weeks, just to make me wrong, but the 3 weeks to many months is the typical consolidation period before we start to see primary moves re-establish themselves. So the market digests certain levels of price to find out if the buyers are still there or if there's news coming or something like that, and then the market makes its decision and we move on. And so a downtrend is identified by a lower high, I should say, then a break of the low, and defines the downtrend. And this chart, Whitehaven Coal, this is the observation with the high as it ran up in 2022 into the $11 high, pulled back, made a higher low, and then it set a lower high and moved lower and broke that low into a downtrend, lower low, lower high, lower low, and then a lower high again, and then that should be a higher low, and then a higher high, higher low, higher high coming out of there. So the basis of trend trading is around this observation that we really want a weekly chart to start to show these types of price actions over time. So there's the distance between the highs and the lows. It needs that trending action to establish itself as a trend over a longer period of time. Trends aren't established in 1 or 2 days. Again, we can apply our primary, secondary observations and see that during the decline here, January, February last year, there was a secondary consolidation and the market simply declined further. One of the key tragedies I see in retail traders more often than not is they'll look at something like this where there's a green bar in there and think we're on again to break into new highs without any evidence of trend change other than the fact that there's an up bar in there, and only to see trades basically end up on the wrong side of the market and exits have to be taken. One of the key observations inside this trend observation is this thing called a spike point. And I've got a description here. I've done them in blue because there's the color of the bars is not that important. What's important is that the bar on the left here made a high point, the middle bar made a higher high point, and the third bar made a lower high point in the range. And so we get left with this spike high, what we call a spike high point. There's one of these at every single reverse point in the market. Every single one, you'll find one of these described as this is described. And as I said, the relevance of the colors is irrelevant at this stage. And also we see spike lows where we have the higher low prior to the bar making the low, and then followed by a higher low bar in there, and this is now described as spike low, and you'll find one of these at every swing point in the market in every time frame as well. So we want to qualify that high and that low in there. So one of the ways of qualifying whether we have a valid spike low or a spike high is the observation of the closing price on the bar that follows. And if we get a closing price above that high of the bar that made the low, we have a valid pivot point. I know people talk about pivot points as the support resistance systems in floor trading, but the pivot point in swing trading is when a bar closes over the high of the bar that actually makes the low. So it must have a higher low next to it, and we get a spike low observation, and this creates a valid pivot point. And this is what it looks like in a chart, where we have the closing price over the high of the bar that actually made the low. And the swing high point is when the bar has made the high, followed by a lower high, and then the closing price of the bar is below the low of the bar that makes the high. And there's our observation up here, up in here. So it becomes that we saw the market swing lower here. There was no close below the low of the bar, that this point up here, the lower high either side. There was no closing price below that low, so everything was intact. And then we saw it swing a little higher up here. We'll accept up to 3 bars after the low as a valid swing point. So markets made the low within 3 bars, 1, 2, 3. We'll accept the closing, nothing more than that. We'll accept the closing price over that high. Providing the market hasn't made a new low, we'll accept that closing price over that high as a valid pivot point. Oh, sorry about my spelling there. My text graphic thing has gone awry, but this is what it looks like in a graphic. You'll notice just to the left of this graphic, of this price action graphic, you'll notice that there was a pivot point set here which failed into a new low, and which set a new low down here, and then 1, 2, the third bar later set another pivot point. The reason that I talk about this a lot is for retail traders that don't have algorithmic exposure, or without any programming language whatsoever, can go into their charts and observe this by hand, write down the results on the back of an envelope. What happens when you get a pivot point? What happens after that? Does it produce a trade or not? And go through and produce some numbers on the back, as I said, on the back of an envelope, on a piece of A4 ruled paper. Just write them down and see if this actually produces a tradable result in whatever it is you're looking at, in whatever time frame you're looking at as well. So there's a high there, better. So there's the observation. The bar closes over the high of the bar that actually made the low within 3 bars. Excuse me. But we notice the difficulty with this is when you look through your charts, there's a lot of them. They're like everywhere. And so I've marked up this one just to highlight how many there are, and they show up everywhere. So how do we define which ones are important and which ones aren't? Which ones actually lead to something and which ones don't? One of the key aspects of this observation is around the 20-day, what we call a 20-day spike high or a 20-day spike low. So a filter around that is to start to observe when we start to see spike low points or spike high points at a 20-day low price, or at least a 20-day low price or a 20-day high price. And I'll show you some examples of that. So it's a simple, very, very simple count back. So we have here the bar of, nominate this one in the middle here, 20, this is the 20-day low price, 19, 18, 17, 16, 15, 14, 13, 12, all the way back. So yes, it's a 20-day low price. It's made a spike low. It's got the higher low next to it. Nothing came of it, and we went on to make a new spike low down here, and nothing came of that. We went on to make a new spike low here, and we got a pivot bar out of that, and we went on to make a new spike low with a pivot bar. This number 14 is the pivot bar over the high of the bar that made the low, and that one gave us the trade. You'll see a number of failures in this, as everyone now knows. Hopefully, trading is not a 100% game. The single thing that will improve your trading success is to be able to take a stop, is position size and take a stop when the observation is wrong. So, and the spike low and then the spike high up here, this turns out this was the high, 20 bars, 19, 18, 17, 16, 15, and it was at least a 20-day high, set a spike high, and the market reversed out of that observation. So when we filter this into a chart, we can see that the 20-day spike highs and spike lows tend to show up at significant reversal points in the market. Some other observations around some TA need to be made. So if you've got your favorite indicator or something like that, that's fine. But the spike high, spike low, 20-day spike high, spike low is a key aspect of defining some swing points particularly in our daily charts in there. This is the Metastock code for that. If you want to take a snap of that, one of the observations around that, one of the better observations around that was made by Lawrence Connor, and he wrote a book with Linda Reschke called Street Smarts back in 1995. And he said, with so many trend following breakout traders in the investment area, the rewards are large when a breakout fails and reverses. I just want to go back two slides. You'll notice that when prices actually start to break over significant highs, previous significant highs, you tend to get the reversals. And here was the high in here. This one broke out, just pipped over that high, and we saw the reversal. The spike high here, we saw one bar cross that high and then the reversal. And then that's the spike high, and we saw two bars cross that high, and we saw the reversal down there. I would question whether breakout trading is a viable strategy to run with. The turtle traders made millions out of breakout trading, and if you look at their statistics, they had a failure rate of over 60%, but they acknowledged their stops every single time, and so their stops saved them, and they let their winners run on the ones that did break and keep going. All right, let's talk about Haguro method, one of the free apps inside Metastock. As I said, Jeffrey and I spent some time getting this together in there. It is free. It's very, very easy to use. And I just want to go through the observation of Haguro and how it can help us in our analysis on a weekly basis if we have a medium to longish term outlook on the charts. It may help you intraday trading if you look at the weekly chart and decide where we are on a weekly basis, whether we're going to go long or go short on a shorter time frame. Haguro can help you with that. So I point out that Haguro is only used on the weekly charts, and the Haguros are conducted on the explorations are conducted on a Friday or on the weekend. So we need the week to close for the weekly bar to complete before we start our exploration to look for particular bars or to make our observation, our weekly observation. The week actually has to finish on there. One of the key observations around Haguro is this observation of long or short body on a weekly basis. And it is simply observing the current bar against the previous 2, 3, or 4 bars back. Is it a long period or is it a short period against the previous bars? So you'll hear me talk about this a little bit as we go forward. Candles are designated to be long or short by observation against the recent periods. And so on the right-hand side here, we have a short period against the previous periods. It's regarded as a short period. And I'll also talk about what we call a high price area and a low price area. And simply, I'll more detail in a moment, but a high price area, of course, is where markets have made a run and start to consolidate higher. That's a high price area. Low price area is where a market has declined and started to consolidate, becomes a low price area. Anybody looking at silver and gold at the moment, they're both sitting at what we would call a high price area. Irregardless of what the media says about where they're all going, currently they're sitting at a high price area. The other observation of what Haguro is really built around is the relationship between the body and the range. So the range being the high to low range of the week, and the placement of the body within that range. So the open close of the week, the Monday open, Friday close of the week. The trader is concerned with viewing both the range and the position of the body within the range. That's what Haguro is built around, that observation of a week's price action, a week's trading, and about where the market had been and where the market settled at the end of the week. And so the simple observation is the body in the low part of the range is simply regarded as a low body compared to the range, and the body open close in the high part of the range is simply a high body within the range. And so in the weekly charts, these are the only 8 types of green candles you will see in a weekly chart. And the key aspect here is the middle of the range. So the middle point through here of the range of the bars. And we can see number 1 has the open close below the middle of the range for the week, and number 2 has the open close over the range, the middle of the range for the week, and number 3 has the open close above the middle of the range of the week. A lot of people regard this type of bar, number 3, as a very bullish bar. In Haguro, in the weekly methods, it's a very bearish bar, and I'll show you what that means in a moment. Then number 4, no shadow at the top, a Bozu bar. Number 5, no shadow at the bottom. Number 6, no shadow at the bottom, but the body is below the mid-range. Number 7, no shadow at the top, no wick at the top, and the body is above the mid-range. And number 8 is simply open, close at the range, at the low and high range of the week. The corresponding down close bars for the week are grouped into this. I know the numbers aren't in order, but the number 9, body is above the middle of the range for the week. Number 16, the body is over the middle of the range for the week. This bar shows up a lot in weekly charts. Number 15 is a key reversal bar when found at a low price, and when found at a high price, it's also a key reversal bar. So you can see they're the same as the green candles, no shadow at the top, body is above the middle of the range, no shadow at the bottom, body is below the middle of the range, and simply the opening price at the high and the closing price at the low for the week. The Morobozu candle in there described as number 11. Very rarely shows up number 11, but it's there. So Haguro is based around that observation. Inside Metastock, to put a Haguro template on, when we select the chart icon in the Power Console, we really want to set, apply a template to that on a weekly basis. So the interval must be weekly. We apply the template, Haguro template, on there, and our charts will open with that on there. So that's that observation. When you open a chart, a weekly chart with Haguro, this is what you get. There are a number of aspects here I'm going to go through in a little bit of detail. The first one, first of all, you'll see that all the bars are numbered all the way to the last bar. And if you're looking at this on a Tuesday, Wednesday, the last bar will still be numbered, but as you would be aware, it's not the finished weekly bar. So it's the previous bar that we're interested in. If we're looking at during the middle of the week, the last bar is quite irrelevant at that stage. And up at the top here, we have a range indicator. Jeffrey did a brilliant job with this. It's really an observe around major swing points, and when they have exceeded a 10% range, we can see on the right-hand side here, 10%, the 2 horizontal lines. And then the black line, and I'll go through this in a moment, is essentially the Haguro midpoint. So inside the Haguro method, we use the large range bar to define the middle of that range as the support and as the resistance point in the chart. And we can see on the right-hand edge, this is Apple. We can see on the right-hand edge that Apple resistance point, Haguro midpoint, is sitting at 174.36. If you were looking for a break, a close over that resistance point, simply set an alert and observe what happens, what type of bar occurs to break over that. So in the to attach the expert advisor, we simply come in, attach the expert commentary, and it will give us the description of each candle. And if we click on the line that the bar is on, it will basically go to that expert advisor and give you the prognosis for that particular bar on there. So that's it in a nutshell. Let's go into a bit of detail. Again, up here you can see a little arrow there, candle number 3, and we notice that the key observation around this, of course, is underlying trend is important, and then our midpoint support resistance line, and then there are some, as we mentioned, some key resistance, key reversal candles that come in. And I mentioned number 3 we saw in the earlier description was a green candle. We've highlighted these in blue, number 3 and number 15, because they are key reversal candles when they show up in a low price area or they show up in a high price area, is the key observation on that. And Jeffrey has done, as I mentioned, a wonderful job with this indicator, that once this zigzag indicator gets over this 10%, we start to really take notice of the numbers and what the potential outcome of those are. Now, this is not a trading system per se, it's a market observation that you may want to sit a little closer to your seat when reversal bars are highlighted and reversal bars come up into your charts. So the 2 key observations again, we have this fluid primary movement in our charts, and we have our secondary observations. And we're looking for key reversals. Once we get this fluid movement into a high price area, we start to look at these key reversals on a weekly basis as potential turning points, and also in the low price areas, key reversals in the low price area. So I'll just go a little bit more detail into this upper line here. This, when it's below, we've got 10% set here. When it's below that, we tend to see significant swing points in price action. And of course, when it's up here, way out here, nearly 50% since the last low, we tend to also see swing points occur, significant swing points occur in the chart. And then down here, set a low down there and swing point, and here in December, January, swing point in the chart again, and we saw the price decline from that. It is really clever piece of programming on this zigzag observation. So the midpoint support and resistance, we talked about that just a moment ago. And what we're using to create that midpoint support resistance is the largest range from the previous 3 bars. So over on the left-hand side here, we can see this bar number 16, and it is the largest range high to low than the previous 3 bars on there. So it creates the midpoint, becomes the support and resistance level going forward until we see this bar here, number 2, has turned up on the 19th of January, and it is a larger range than the previous 3 bars, so it creates a new support resistance level. And then number 9 turned up there, which was also a larger range than the previous 3 bars, and creates a new support resistance level going forward until we get down to here. And we saw price break below that, but down in here we see that on the 8th of March, the bar 16, largest range in the previous 3 bars, creates our new support resistance level. And then on the 22nd, the new range turned up, larger than the previous 3 ranges, so it also creates a new support resistance level. So very dynamic observation of support and resistance based around the midpoint of your weekly range, of your large weekly range. So it's that observation there. And the current, this is Apple, I think it's about a week ago, current resistance was 174.36. I think Apple's traded a little lower since then, but really tells you that that's what the current midpoint Haguro resistance level is. So again, if we want to search for these bar number 3, and I mentioned bar number 3 and bar number 15, there's one in there. If we really want to search for these as key reversal points, we can do that also in the Explorer. So we want to go into the Explorer in the Power Console, highlight the Haguro candle 15 or Haguro candle 3 in a 10% range. In this case, nominate to search the S&P 500, and it pops these into here. We start our exploration. There are the two observers. They're the two ones we've selected, and the S&P 500. And we start our exploration down here. And these are the two lines that we're searching for. The key observation around this number 3 bar, which is the green one, when this is found in a high price area, long position should be closed within a week. If the opening price of the following week is above the midpoint, selling is still indicated, short positions could be held. So short position should be closed with a closing price above the high price. So if we close above this high, then we're wrong about our short position, and we simply have to close it out. And number 15, which is the red one, the body is below the middle of the range for the week. Line 15 indicates erratic price movements in the following weeks, as this line makes an appearance when the price is declining and can indicate a low area. When found in a high price area, close long positions when the following week trades and closes below the line 15 low, or take short positions. If line 15 is found in a low price area and the following line is green, this is a strong buying. This is strong buying. All short positions should be closed and long positions open. So this is a bullish bar when found in a low price area and a bearish bar when found in a high price area. I did a search of the S&P 500. These stocks came up this morning or tonight for some, and just take a look at a couple of them. There's Dover Corp. We can see that number 3 bar has turned up several weeks prior, and there's the notes, Haguro method notes, line 3 found in a high price area. Long position should be closed within a week. So it's not a instant trading decision. This, as I point out often, this is a guide to your analysis. It's not the trading method in itself, it's simply a guide. We saw the number 3 bar turn up here on the way, and the market reversed for 3 weeks. We saw number 15 bar here on the left, and we didn't see a green bar after that, so really nothing to do. One of the other observations here was in the recent price action was this, the little arrows covered up, that's a number 9 bar. When line number 9 appears, a trader should wait for direction. The body is above the midpoint. When the closing price is lower than the open, if this is a short line, the trader should wait for the market to show direction. Well, this week we've actually shown direction on that with a number 16, which is a key reversal bar in there. So the body covers a range of the week, and it's also closed below the low of that bar. I think this number 3 back here is the highest bar. So certainly 1, 2, 3 bars we've created a pivot as well. So Dover Corp might be worth observing that in your trading methodologies. So line number 9. And so the other one that we searched for is line number 3. So I've done this search on the XJO 200, the Australian index. Did this also this morning after the close. Only really got 1, 2, 3, 4, 5, 6 charts came up on that, so it's not that often. But we saw this in A2 milk came up, and then last week simply reversed out of there into a pivot point on A2 milk. So the largest range still sits here, support at $5.68. When you're building an observation of your investment or trading, you've got to decide whether this is important or not. It gave a line 15 at the low, a line 3 at the low, really not to be taken notice of in low price areas. We saw the market decline. but then we saw the bar number 2 turn itself into a pivot point, and we saw this rally on the way through. So, but bar number 3 turned up here in a high price area in consolidation, put in a new spike high up here, and we saw the reverse into a pivot. And Cleanaway did the same thing, but I also point out again that this is really just a consolidation area, but we saw bar number 3 here, price simply reversed down into these lows. We saw it again here, and price reversed out of those lows on there. So bar number 3, when found in a high price area, it put in a low back in October, November, back here with an outside range, but really has consolidated since then. And which also should be part of your observation. Do you want to get caught up in these consolidations along the way? Charter Hall did the same thing. Just go through this. Candle number 15, I've talked about this just previously, was one of the other searches, but in hindsight here, we saw market made a rally up here in December, set a bar number 15, and we saw the market decline into these lows and then set bar number 1 I'll come to in a moment, and bar number 5 in there, which is a shaven base and high close, which is quite a bullish bar. And we saw the rally, and then the bar number 3 showed up again at the top in this fluid movement higher into these high points. And we see that our range indicator, our zigzag indicator, is well out over 10. So these should be taken notice of when the indicator is outside this 10% range on there. Horizon Holdings, bar number 15, has showed up in there, followed by which followed a bar number 3, which gave you the warning that there's a top coming. Bar number 15 shows up here in a high price area after this run out of $3.40 into $3.80, and bar number 3, bar number 15. But I brought this up. We talked about candle number 2. Candle number 2, which is these green bars that have a shadow at the base and a shadow at the top, but the body covers most of the range of the week. And when we get them in, find them in low price areas, when market declines and we find them in low price areas, when this is a long line, the midpoint is set for future support on any declining prices. Concerning line number 2, this appears at the outset of a rise in the market after a fall in prices. That's the key bit. And a further opening price above the midpoint in the following price movement should occur. So we're really waiting for the next week. But we saw bar number 2 in here in the lows. We saw the spike low here. But the next week opened and closed above that bar number 2 and set this short rally in play. And then Northern Star, everyone's interested in Northern Star at the moment. Interesting enough, a week ago it set bar number 3 and then went on to set a new bar number 2 support sitting around $14.04 in there. And I'll just point out back here, bar number 15 says when it's found in a low price area, not an ideal example, but it was followed by a green bar which set this current run. Bar number 16, which is a reversal bar, set the pivot point into these lows, and then it re-established itself bar number 2 and re-established itself higher. So this is worthwhile watching this week. It has the bar number 3 in there. It says that found in a high price area, long position should be closed within a week. So it gives you a bit of warning. That's why a couple of them are in the background a little bit, but it gives you a bit of warning that there's and seeing the price of gold last night, I would suggest we might get a lower price on this on Monday morning. But the telltale signs are there. So I mentioned earlier, a lot of people view this, this is actually a green bar, view this type of price action as quite bullish, and it's simply not. Simply, they show up regularly prior to a reversal in price when found in high price areas, and when markets have had a bit of a run, they show up regularly. So I'll just go through quickly again what this is about. The weekly line is taken from the daily line over 5 trading days. Monday's opening price through Friday's closing price and the highs and lows during the trading period. And again, the Haguro classifies lines into 8 types of lines and places them into 2 groups. Little importance is placed on the main body. It's a matter of anticipating the future using similar types as we've seen so far. So the middle of the price, the middle of the range is the key here in our observation of Haguro, and whether the body is below the middle of the range or the body is above the middle of the range. We saw line 15 and line number 3, the bodies are above the middle of the range and concerning line number 3, and the body is below the middle of the range concerning line number 15. So again, these are the examples of the green candles and the red candles in there. So as we see line number 15, the body is below the midpoint. I'll go through a couple of them, just clarify out. We mentioned line number 1 before. Line number 1, 1 week's movement of the body is below the midpoint, so we can see the end of the week, the body has resulted below the midpoint of the range. If this is found with an uptrend, the following price lines, even if a rise in price takes place, will be limited and a lower price will be set. So this is again signaling reversal. In simple candle methodology, a lot of people will look at this and go, well, that's the reversal wick anyway. In Haguro, it's the reversal wick if it's found in a high price area. If it shows up within a downtrend, if the price declines from this week, look for a rising price within a few days and buy. So we can go back to a shorter time frame and in our daily charts, look for a pivot point of some sort. And if this is observed in the weekly chart, we're looking in the following week or the week after to looking for a rising price and then start to buy. And so some examples here, line number 9 in here, line number 1, there says that a high price, any further gains could be limited, and we saw that, and the price reversed out of there. Line number 9 appears the body's above the midpoint. The short line, the trader should wait for direction. If it's a long line, selling is indicated when trading in the underlying direction of the trend. I'll just go back in there. So if this is a short line, price gains will be limited. We saw that, and the market fell, declined after that. So it is worthwhile going through your notes and testing out the observation on your charts with this indicator. Just number 9. Line 2 and 16. I just wanted to get to these two, line 2 and 16. Line 2 and 16 show the body midway, so they've covered the middle of the range of the week. Line number 2 appears at the outset of a rise in the market after a fall in prices, and a further opening above the midpoint in the following prices should occur. The fourth week of upward movement, the trade should be liquidated. It is rare that you'll find more than 4 weeks of advancement in price before you enter into some consolidation period. Remember the 20-day high and low, 4 weeks. Wait for the next week's price action to open above the midpoint of the line of the week. If the price closes below the midpoint of the line, close any long positions. So line number 2 often begins a new advance in prices. There's line number 16 at the low. And line number 2 can give an indication of market top 2 weeks in advance if found after a continued rise in prices. When the price falls, the next week's open position should be closed. So it's essentially in here that we're looking to close our positions. And line number 16, which was the red one, it also appears on a regular basis. Can be opened. Long positions can be opened when the following week's price trades below the midpoint and rises above the midpoint. So the line number 16 here down the below here, the middle of that range is the price. The following bar opened below the middle of that range and closed above the middle of that range, and that's your buy signal against this line number 16. And if you wanted a pivot point, there's the high of that bar as well. There's your close above that high, and market made an advance after that. So it also infers that your stop should be set away from the current price action. So you must give it a little bit of room to move, which comes down to your position sizing. Line number 16 in a high price area, we saw that set up the midpoint resistance. The following week tested that and fell away, and we saw prices reduce after that. And again, lines 3 and 15 found in a high price area, and line 15 found in a low price area. I'll just leave this, and I've got some other charts that I'm going to attempt to get out of my PowerPoint presentation. I think that's right, Jeffrey. You can now see my Metastock screen.
Yes,
All right,
sir.
I'll take it. Take it. You can.
Yes, we can see it.
Okay. So I talked about Whitehaven coal a moment ago. So this is just some charts I got out this morning to have a look at. Whitehaven coal, the recent advance into January, February, we saw bar number 3 at the top, and then we saw bar number 1. If I click on bar number 1 up there, so if I highlight that line, it gives a little arrow there. Bar number 1, after 1 week's movement, the body is below the midpoint, indicating buying at a lower price. With a downtrend, a low price area short covering, the following price lines, even if a rise takes place, will be limited. With an uptrend, so we saw this actually trending up on this weekly chart, and with an uptrend, rejection of higher prices. If the price declines from this week, look for a rising price within a few days and buy. We really didn't see that. It just simply declined out of there, and there's the bar number 1 at the low in there. So, and then we saw prices rise by number 2 and so on out there. So it's really worthwhile having a look. I'll just drag that to the side. The other one that I wanted to look at was this WiseTech. WiseTech also showed bar number 15 at the high, so just to remind you. Reversal line when found in a high price area. So the observation is that this is a high price area because the consolidation occurred back here. We had a fluid movement out, and then bar number 15 showed up. We also saw a close below the low just there 2 weeks ago. Below, that's the low of the bar. That bar didn't close below there, but this bar did. And then we saw this bar number 9. And so let's take a look. When line number 9 appears, the trader should wait for direction. The body is above the midpoint of the closing price, lower than the open. If it's a short line, so this is considered a short line, the trader should wait for the market to show direction. So the following price movements can engulf this, which essentially means we're going to enter into a consolidation area around this $90 area on there. So because the trend is up, once we start to consolidate, we then start to look for bar number 2, which is the reversal out of there, potential reversal out of there. And so far I'll just drag this down a bit. So far our swing indicator is still within that 10% range. So really nothing to do here. We really want that to be out below that -10 to give us a stronger signal on there. So that's better, to give us a stronger signal than what we've got on our chart. So that's, I think that's me, Jeffrey. That's about all I can offer on this. There's there's quite a bit of information in the whole thing. Very easy to put a template on your chart. The descriptions are there, and go and prove it to yourself. And I think you'll find it will be a helpful tool in your short, medium to longish term observations of the market. Always used on a weekly chart. It's a signal tool, not a get out of your seat and do something tool. It's basically a signal tool that you need to follow up in the following week. All right, Jeffrey, if there's any questions, I'm more than happy to take those, but we're sitting on our hour at the moment.
Yeah, absolutely. We do have just a few questions too, if you don't mind.
Yeah.
Jerry wants to know, is there a reason you set the zigzag indicator to use the bar/candle close during the trend, during the primary and secondary slides?
A reason to, not sure what he means there. This is the trend indicator.
I think he's wondering if there's a reason that we used. So when we calculated this, which was a while ago, Jerry, I think he's wondering if there's a reason that when we coded it, we looked at the closes instead of the high to low swing. And that's a really good question.
It is a really good question. Well, hopefully I can answer it.
Go ahead.
Or I'll simply make something up. No, I'm not going to do that. One of the observations around price action is that trends, there's two methodologies around trend. One is the range of the bar, using the high-low range of the bar as if the future breaks that high-low, we declare trends out of that. And of course, if you're using line charts, the closing price is the simplest method of observing when significant swings come in and highs and swing lows come in. Other than that, I don't have an answer for Jerry, but I'll certainly give it some thought. I know, Jeffrey, we did, we programmed this some years ago, but we did put some thought into what constitutes these highs, and it's certainly sitting in this indicator at the moment.
It is also open too, Jerry. So if you wanted to play with it, you could. So
yeah. We can change these. You can edit these ranges. This 10% range, you can edit those. But over the years, I've found no need to do that.
John wants to know if you could look at a gold chart.
Gold chart? I don't think I can. I can look at a gold chart on Icon, because I don't have the futures.
I think if you do GLD equals in Metastock, you should be able to pull it up.
Yeah. Should I? Oh, rather than let me go to my gold chart on. So this is the gold futures chart. If we get this is what occurred last night. If we get this on a weekly basis, I won't interfere with the one on the right. That's something I use. So we can see here we actually have bar number 1 showing up this week on this weekly chart. This gold futures chart. Bar number 1 has shown up here. We saw one here as well. Nothing traded below the low there, so it really didn't set a pivot. So this is the key aspect now, is whether we get movement below this low. If I go back into bar number 1, let me find one so I can bring it up. So bar number 1 is that with an uptrend, if the price declines from this week, look for a rising price within a few days. There's a great opportunity to go long in there. But I would suggest that we're also in a high price area with that. We're certainly in a high price area up here. So you can imagine those sitting on profit would be getting a little nervous after last night's price action. It is, if I go back into the daily chart of this, it is certainly a 20-day high out here. We saw one pivot reversal here against this move. If we saw another one here, it would be, I think, worthy of taking notice of. But certainly the primary trend on the weekly basis and the daily basis on gold is up. We see a primary trend higher low, higher highs in there. So if we saw a decline, it's these declines in an uptrend that really give the information about how we're going. So don't be surprised if we did see some retracement here and gold resettled itself and found the buyers again and moved higher again. But these declines are so important in our observations. I'll just point out also, getting a little bit off track, but when you look at price structure from lows to highs, we find that these declines often fall into 33 to 66% of the initial advance. When you look at these retracement declines in here, when markets go into secondary movements, they often retrace into 33 to 66% of the initial advance. Now that's not a Fibonacci thing, it's not an Elliott wave thing or anything like that, it's just simply an observation over basically 100 years of price action that this simply occurs. And so if we apply that rule to this move and we started to see consolidation, then don't be surprised if gold pulled back into this 2,200 level, somewhere in there, to first of all test this breakout, our breakout level, to test that level as part of our overall structure of the chart. So then it comes down to your time frame. If this is enough, then that's your trade, and if you're willing to go with the view that gold is going higher and it gives you evidence of that, then that's where you should be.
Joe would want to know, or Joe has a question on where do you put your stops?
You want to know what my real answer to that is, and I'm not joking. Listen to this carefully.
Go.
It does not matter where you put your stop. The placement of your, hear me out, the placement of your stop is irrelevant. What's relevant, what's extremely relevant, is your position size against that stop. So what I mean by that, and I'll go back, I can do it here. If we decide we're going to go long on Monday's open, on WiseTech Global, what that means is that if we place our stop here, oops, sorry, getting excited when people talk about stops, or we place our stop down here, if you position size yourself so that from your entry price to your stop, or from your entry price to your stop, you lose the same amount of money as a percentage of your account. I have a lot to say about this, about traders who put random amounts of money onto a trade, and so they get random results out of their P&L. If the entry price to the stop generates a percentage loss in your account, 1%, 2%, 5%, whatever you choose, you can have your stop from here to here, and if the price goes there, you still only lose 5% of your account, or 2%, or whatever it is you choose to risk. It's the consistency in your position sizing that will turn your account into a profitable account. Simple as that. And I have in other work, I have statistics to prove that.
I love that there's an answer, because so many people don't talk about how important sizing is and position size. That was a great answer. So Joe also wants to know, how do you know where there is a failure in your method?
When you get stopped.
Which does happen, right?
Which happens a lot. I mean, you look at some of the best trading systems and they're 50-50. People brag about being 60-40 win rate and struggle to, that doesn't prove that the system is profitable. It means you win more often than you lose, but if you lose more than you win, then 60-40 is not going to help you.
All right, here's another one. We have, I think, two more. So Anthony wanted to know, is the 20-day spike the same as being above or below the 20-day moving average?
Don't know. Never looked at that, but good question. Don't know. There's your homework, Anthony.
And then Mike says, once the swing point indicator occurs, how do we know when we're getting close to exhaustion?
When you start to see markets consolidate like this, or a swing pivot point come in, or as I mentioned earlier, you've had 4 weeks of advancement in price. I digress a little bit here, Jeffrey. I was giving a talk in Sydney once, and someone put their hand up and said, well, I was in a trade the other day and I took a small profit, but then I watched it just go to where I thought it was going to go. And he was quite upset about it. And the only answer I had for him at the time was, You know, you took a profit on a trade, you have no idea what's going to happen in the future, but you took a profit on the trade and you make yourself feel bad about it. So if, you know, when do the good times start here? Now, profit is a profit at the end of the day. The key, and I go back to this observation here, the key is in your stop loss position sizing. That's the whole key to trading. You don't see guys in institutional rooms taking swings with half their account on something that they've got a gut feeling about. It doesn't occur like that. They wouldn't get past risk management anyway. So
All right.
that's, you know, that's really our key here, is the stop loss is the key to trading success. And over my years of trading, that's certainly been the case. It took me a little while to get my head around that. It was more than 15 years ago. But I had a guide really drum that into me and prove it out with statistics. So work through your charts and prove it out. If you take a stop on a reverse pivot, or take a stop on you know, trailing stop, or set your stop below there and position size yourself, because the key with this, and we're talking hindsight here, but let's say your entry was here and your stop was here. If you get stopped out here, you lose 1%, 2%, whatever you choose of your account. But the key aspect of that is that when you go the equal amount this way, you make 1 or 2% in your account, and when you go again, you make 1 or 2 or 3%, and so on. This side becomes fixed, this side becomes unlimited. Casinos work the same way. They lose a fixed amount. That's me, Jeff.
All right. Mike C says, thank you heaps. This makes a lot of sense. Thank you. So,
okay.
Thank you, Gary. I appreciate that. That is the end of the questions. Really, I love sessions like this. I really appreciate your coming in, spending a minute with us, or an hour.
Believe me, it's a pleasure. It's a pleasure, Jeffrey.
All right, very cool. I'm just going to kind of thank the people that kind of helped us put the session together again, and then we'll close the room. But Gary, it's been great. Thank you. I'm glad I ran into you in Australia so many years ago. That was it's been a very, very cool journey.
Yep. Thanks, Jeff. Thank you, Jeffrey. And thank you everyone for coming along.
All right. So to wrap up, I do, just in case, we did ask a question a little bit earlier about if this is available in Metastock. Gary was gracious enough to include it to everybody that's a Metastock user. And so with our appreciation and all that kind of stuff. So we do have a bit of a special. Normally a Metastock, if you get our end of day subscription, would cost you about $59 a month, and a real time would cost you just about $210 a month. What we're going to do, if you want to try it out, there's no risk to this. If you pay for a month, we'll give you a second and third month for free. That'll be any of the data that you're interested in. If you're interested in Australian data, that'll be included. You could get North American data. I think most of you guys are Australian, so you're probably interested in the Australian data, but that'll also include the latest version of Metastock, as well as some training on how to run everything and unlimited access to our technical support. So you can do that at metastock.com/tradersoracle 3-for-1, and that's in the YouTube chat and it's in the chat here. In addition to that, I do want to say thank you for the Australian technical analysis. I would encourage you to kind of join that, be part of it, no obligation for a month. Go to ataa.asn.au/metastock-2024. And then I'm going to go ahead and put that back in the chat here real quick, just because it's been a minute. Let me go ahead and type it real quick. ataa.asn.au. And yes, I have to type and talk at the same time. As long as I'm saying the same thing I'm typing, it does help. So there you go. There we go. And then again, if you are in Australia, you want a local provider for Metastock, metastockaustralia.com.au. Traders Oracle, they've been a partner of Metastock for a number of years now. They do a really, really good job. If you go here for the Traders Oracle 3-for-1 offer, but if you have any questions, if you want to talk about Metastock, you can call, you can go to the website, whatever works best for you. So Sophie, thanks for coming. I appreciate your coming in. Alex, thank you also for coming. And thank you, Gary, for being here. So with that being said, I do want to say thanks, everybody. I hope you have a great day. I know it's the middle of the day for most of you, so I hope you have a great day. If you guys need anything, let me know. Nice name, Jeffrey, by the way. Thank you. We hope to see you again. So stay healthy, stay well. We'll see you at the next one.